4 transfers, each one for 410 million euros. The auditors requested them as a test. Not one moved. That sequence comes from EY auditor Christian Orth's testimony to a German parliamentary committee. And it leads to a question that should be simple. If cash is sitting at a bank, why did it take years to call the bank? Before this is over, you will see how the same claim collected approval from trustees, auditors, regulators, lenders, and Germany's premier stock index without verification, reaching the one place that could prove it. Approval is not proof. Cash has to clear.
Wirecard did not look like a back alley operation. It was a German payments company. It joined the DAX in 2018. Its annual report for that year showed more than 2 billion euros in revenue, an average of more than 5,000 employees, and an unqualified audit opinion from EY. That stack of approval matters. An index committee sees the listing. Banks see the audit. Investors see the banks. Regulators see the filings. Everybody sees somebody else standing in the room. For an ordinary person with Wirecard inside a retirement account, doubt could feel less like caution and more like paranoia. But respected names can all be reading from the same document. And the document is not a bank balance.
Part of Wirecard's story ran through something called third-party acquiring. Here is the clean version. A merchant accepts a card. A licensed acquirer connects that sale to the card network and settles the money. Where Wirecard said it could not perform that regulated step itself, an outside acquiring partner did it. Wirecard said it supplied technology or acted as the middleman. Wirecard recorded business from those partners and said related cash was being held by trustees in bank accounts for Wirecard's benefit. Merchant to partner, partner to trustee, trustee to bank, bank confirmation back to auditor. Every extra hand creates distance. Distance is not fraud, but distance is where verification has to get stronger. If the cash is at a bank, you do not ask the folder. You call the bank. In late 2019, KPMG began a special investigation into the allegations around Wirecard. Its lead investigator later told the same parliamentary committee that the team grew to as many as 40 people. Even then, Wirecard created major obstacles, and KPMG could not obtain sufficient evidence for claimed Asian accounts, revenue, transfers, and merchant relationships. Wirecard's public framing was much brighter. It emphasized that the review had not found incriminating evidence, while acknowledging that KPMG could not obtain all the data needed to prove historic third-party business. That is a dangerous sentence in finance. No proof of wrongdoing is not the same as proof that the cash exists. By mid-May 2020, according to Orth, the auditors tried a more physical test: move the money. 4 requested transfers, 410 million euros each. Nothing moved.
Now the verification chain starts collapsing. Orth said the auditors had visited banks in Manila in March, but on June 16, direct contact with bank leadership produced the answer that years of documents had not. According to his committee testimony, the purported accounts did not exist. Not empty accounts, not accounts with a paperwork problem, accounts that, according to that testimony, did not exist. This is the payoff. The fraud allegation is complicated. The proof failure is not. The balance had traveled through a chain of approvals. Independent confirmation had not traveled all the way back to the original outside source.
And years of reputation died in 7 days. June 18. Wirecard disclosed that EY lacked sufficient audit evidence for 1.9 billion euros in reported trust account cash, about 1/4 of the consolidated balance sheet. The 2019 audit was not completed. Wirecard also warned that roughly 2 billion euros in loans could become terminable without certified statements. June 22nd. Wirecard's own management board said the prevailing likelihood was that the 1.9 billion euros did not exist. It also said its previous descriptions of the third-party acquiring business might not be correct. June 25th. Wirecard filed for insolvency. Be precise about the number. This was reported TPA-related trust account cash. It was not established customer deposits. It was not revenue. And it is not money this episode can declare stolen. The honest claim is already devastating. 1/4 of the balance sheet was supported by a verification chain that failed at the bank. The collapse did not stay inside an accounting file. By the end of 2022, Munich's court had received 2,251 Wirecard-related proceedings, including 1,178 investor cases against EY. Wirecard's last complete annual report had listed more than 5,000 employees. In Britain, restrictions imposed on Wirecard's regulated subsidiary temporarily stopped some customers from using payment cards. Government updates included people receiving benefits through prepaid card services. That is what a broken trust chain looks like in real life. For more than 1,000 investors, the fallout became litigation against the auditor. For some UK customers, a payment card stopped working over the weekend. The paperwork was abstract. The damage was not.
Europe's securities regulator later found deficiencies in Germany's financial reporting supervision. The problems included late or absent risk-based review, weak scope and professional skepticism, and coordination failures. That does not mean the regulator joined the alleged scheme. It means the system built to challenge the filings did not challenge them well enough. Germany later overhauled that system. In 2024, ESMA said the country's supervision had been substantially revised and strengthened. Good. But stronger supervision does not cancel the viewer's job. When one number is carrying the story, trace the confirmation to a party that does not need the story to be true. Munich prosecutors allege that substantial third-party acquiring business and related financial statements were fabricated. That is the accusation. The court has not finally decided it. Former Chief Executive Markus Braun has denied wrongdoing and said he did not know about falsification or embezzlement. The main criminal trial remains active. In May 2026, the court scheduled additional dates through December 23, 2026, and explicitly said that date does not mean the trial will end then. So this episode will not hand you a verdict the court has not reached. It does not need one. The company disclosure, the auditor testimony, and the insolvency timeline already prove the money lesson. An audit opinion is assurance. It is not insurance. A famous index is a filter. It is not a vault. A regulator can supervise a process and still miss the asset underneath it. If a company depends on a material cash balance, ask where it is, who confirmed it, and whether that confirmation came directly from the independent institution holding it. You do not need to become a forensic accountant. You need to notice when reputation is doing the work that evidence should be doing. Approval is not proof. Cash has to clear.
This is the money graveyard. We dig up the fortunes that died, so yours does not have to. Wirecard spent years collecting approval. Proof took a week. Buried. Next time, we leave the collapse behind. A company with every reason to disappear survives by doing one unglamorous thing right.